I have learned, after many market campaigns and more than a few hard knocks, that trading damage never begins where most men think it does. It doesn't begin with the loss on the tape or the red figure on the ledger. By the time the P&L shows the wound, the mistake has already grown old. The real injury starts earlier, much earlier, at the exact moment a trader stops following a process and starts listening to an impulse. Have you ever noticed how quiet that moment is? I used to think my losses came from bad luck or clever operators on the other side of the trade. That was before I learned to watch myself more closely than I watched the market. The market only does what it has always done. It moves. But the trader, he changes. He shifts. And that shift is so subtle that most men don't feel it until it costs them money. Isn't it strange how we can sense a coming storm in the weather, but miss it entirely in our own thinking? A sound trading process has a certain rhythm. It is slow, it waits, it observes. You read the chart, you judge the general trend, and you let prices tell their story without interruption. When you are trading properly, there is no urgency. There is no need to act right now. You know what you are looking for, and until it appears, you do nothing. That calm, patient state is the trader at his best. But then something changes. The first sign of trouble is not a losing trade. It is impatience. The trader begins to feel that waiting is costing him money. He glances at the chart too often. He starts seeing, almost, setups. He tells himself that this time is different. Have you ever caught yourself leaning closer to the screen, as if that might make the market move faster? That is not analysis talking. That is impulse clearing its throat. Impulse trading always wears a disguise. It never announces itself honestly. It says, I'm being aggressive. Or, I'm just getting a better entry. It flatters the ego by pretending to be skilled. But process never flatters. Process is dull. It repeats itself. It asks the same questions every day. Is the trend intact? Is the volume confirming? Is the price acting right? When those questions stop being asked, damage is already underway. I have found that the most dangerous moment comes right after a small win or a small loss. After a win, the trader feels clever. After a loss, he feels the need to be right again. In both cases, the chart begins to take a back seat to emotion. The hand reaches for the buy or sell button before the mind finishes its sentence. Do you really think the market cares whether you feel confident or wounded? Charts are honest. They do not rush you. They do not plead. They do not promise. But impulse demands action. It whispers that if you do not act now, you will miss the move of a lifetime. That is how traders abandon their rules without even realizing it. One rule skipped becomes two, then three. Stops are widened. Just this once. Position size grows quietly. The trader is no longer managing risk, he is managing his feelings. The curious thing is that during this shift, everything still looks reasonable on the surface. The trade can be explained. The entry can be justified. That is why the damage is not obvious. The account may even show a profit for a while. But inside, discipline has already cracked. And once discipline cracks, the market has all the time in the world to exploit it. Have you ever noticed how losses seem to grow faster after you stop respecting your own rules? Wealth in trading is not built by boldness at the wrong time. It is built by consistency during boring periods. The trader who survives and prospers is not the one who trades the most, but the one who waits the longest. Process protects capital. Impulse exposes it. Every time you act without confirmation, you are borrowing confidence from the future. And the market always collects its debts with interest. I learned to identify the behavioral shift by watching my own body as much as the chart. When my breathing changed, when my thoughts sped up, when I felt the urge to do something, I knew I was in danger. The chart had not changed, but I had. That was the warning sign. Do you pay attention to how you feel before you place a trade, or only after it goes wrong? A trader's mindset is not about optimism or fearlessness. It is about obedience. Obedience to the rules you set when you were calm, rational, and flat. When you break those rules, you are not rebelling against the market, you are rebelling against your own best judgment. And rebellion has no place in speculation. The market rewards patience and punishes impatience with remarkable consistency. The greatest losses I ever had were not caused by ignorance of chart patterns or trends. They were caused by moments when I knew better and acted anyway. That is the true cost of impulse. It erodes trust in yourself. Once that trust is gone, you begin second, guessing even good trades, and the downward spiral accelerates. Can a trader build wealth if he no longer believes in his own process? The market is a mirror. When you are disciplined, it reflects discipline back at you in the form of manageable risk. When you are reckless, it reflects recklessness in the size and speed of your losses. That reflection begins long before the numbers turn ugly. It begins at the instant you decide that your feelings deserve more attention than your method. If you can learn to spot that instant. When patience turns into restlessness, when observation turns into prediction, you can stop most trading damage before it starts, not by predicting the market, but by policing yourself. That is the real edge. Not a secret indicator or a clever trick, but the ability to remain unchanged while the market moves. When emotions start answering questions the chart hasn't asked, discipline is already slipping. That is not a theory I picked up from a book. That is something the market carved into me, one trade at a time. The chart is a patient thing. It only asks a few questions, and it asks them in the same order every day. Is the trend up, down, or sideways? Is volume confirming price? Is price acting right at key levels? That is all. But the moment a trader begins answering different questions, questions born out of hope, fear, or restlessness, he is no longer trading the chart. He is trading himself. I have watched this happen more times than I care to admit. A trader sits in front of a perfectly ordinary market. Nothing special is happening. Price is moving within its range. The trend has not declared itself. The chart is asking for patience. But the trader's mind begins to wander. He starts asking questions like, what if it breaks out without me? Or, what if this is the bottom? Those are not chart questions. Those are emotional questions. And once emotions start asking, they are quick to answer themselves. Emotion is always in a hurry. It hates uncertainty. The chart, on the other hand, is built on uncertainty. It reveals itself slowly, bar by bar. When a trader respects that pace, he stays aligned with the market. When he does not, he begins to manufacture certainty where none exists. He sees strength where there is only noise. He sees weakness where there is only consolidation. Have you ever noticed how convincing a bad idea sounds when you are tired of waiting? The most dangerous part is that emotional answers often sound reasonable. They use the language of logic while sneaking in the urgency of impulse. A trader will say, volume is picking up, when volume is merely average. Or it's holding support, when support has not been tested. These are half-truths, and half-truths are more dangerous than outright mistakes. They allow the trader to feel justified while stepping away from his process. Charts do not care about how long you have been waiting. They do not reward boredom. They do not punish patience. But emotions keep score. They remember missed trades. They replay past losses. They create a sense of pressure that has nothing to do with price. And when that pressure builds, emotions begin answering questions the chart never raised, such as how you will feel if you do nothing today, or how you will explain inactivity to yourself. I learned early that the market does not require constant participation. It requires correct participation. But emotions hate that idea. Emotions equate activity with progress. They make a trader feel that sitting on his hands is falling behind. That is when discipline weakens. The trader stops asking, is this trade aligned with my method? And starts asking, should I at least take a small position? That word, least, has ruined more accounts than any sudden crash. The chart might be saying, wait for confirmation. Emotion responds by saying, get in early. The chart might be saying, risk is undefined. Emotion answers, I'll manage it later. This is the exact moment when discipline slips, not with a dramatic failure, but with a quiet substitution. Logic is replaced by urgency. Observation is replaced by prediction. And once that switch happens, the trader is operating on a different set of rules without realizing it. I used to think discipline meant forcing myself to follow rules. I later learned it meant protecting myself from answering the wrong questions. A disciplined trader only responds to what is actually happening on the chart. He does not respond to imagined futures or emotional discomfort. The moment you find yourself explaining a trade in terms of feelings, confidence, excitement, frustration, you can be certain the chart has been ignored. This is why many traders are shocked by their losses. They say, everything looked fine. But what they mean is that everything felt fine. The chart may not have confirmed anything, but their emotions had already made the decision. The order was placed long before the mouse was clicked. By the time price moved against them, discipline had already been absent for some time. There is also a subtle arrogance in emotional answers. Emotion assumes it knows what the market is about to do. The chart never assumes. It only reports. When a trader starts anticipating instead of reacting, he is no longer aligned with the market's nature. He is trying to lead instead of follow, and the market is a poor follower. Wealth in trading comes from repetition of correct behavior, not from moments of excitement. Emotional answers break that repetition. They introduce inconsistency. One trade follows the rules, the next bends them, the next ignores them entirely. Over time, the trader no longer knows what his edge is, because he has diluted it with impulse. Can a man build capital if he cannot tell which profits came from skill and which losses came from impatience? The trader who learns to stop when emotions begin answering unasked questions gains a powerful advantage, not because he predicts better, but because he avoids unnecessary exposure. He preserves capital for moments when the chart truly speaks. That preservation is not passive. It is active restraint. It requires awareness. You must notice when your internal dialogue changes from observation to persuasion. I found that the clearest warning sign was when I started negotiating with my own rules. The chart had not changed, but my tolerance for waiting had. That negotiation always came from emotion, never from new information. And once I recognized that pattern, I realized that discipline was not something I lost all at once. It slipped away gradually, disguised as flexibility, disguised as experience, disguised as confidence. The market rewards those who listen more than they speak. Charts speak in price and volume. Emotions speak in urgency and fear. When you answer the latter instead of the former, you are no longer trading the market you see, but the one you feel. And feelings are poor guides in an environment built on probability. Every trader must learn to ask himself one simple question before every trade. Did the chart ask for this, or did I? That question alone can stop more damage than any stop loss. Because once emotions are allowed to answer questions the chart never asked, the trader is already operating outside his process, already drifting away from consistency, already exposing himself to risks he cannot properly measure, already placing capital in the hands of impulse instead of structure, already setting in motion a sequence of decisions that will feel justified in the moment and inexplicable later, already stepping onto a path that looks harmless at first because the market has not yet responded, because price has not yet punished him, because the account still looks intact, because nothing obvious has gone wrong, and that is precisely why it is so dangerous, because the trader believes he is still in control, while discipline has quietly stepped aside, and the longer that goes unnoticed, the more natural it begins to feel, until answering emotional questions becomes habit, until reacting replaces waiting, until the chart becomes background noise and the mind takes center stage, guiding decisions with confidence that has no foundation in price, no confirmation in volume, no support in structure, and once that becomes the normal state, the trader is no longer practicing speculation, but something far closer to gambling. Even though he may still use the language of analysis, still draw his lines, still talk about levels, while inside, the real decisions are being made somewhere else, driven by the need to act, the need to feel involved, the need to escape uncertainty, and as long as that need remains unanswered by discipline, it will continue to speak louder than the chart, filling the silence with explanations that sound reasonable enough to follow, right up until the moment the market finally answers back in its own way, indifferent, exact, and unforgiving, long after the trader has forgotten which question he was supposed to be listening for in the first place. As he sits there watching the price move, trying to remember when observation turned into persuasion, when patience turned into pressure, when discipline gave way not to panic, but to something far more subtle, far more common, far more costly, and far harder to detect while it is happening, because it feels so much like thinking, like reasoning, like experience, when in truth it is simply emotion stepping forward to answer a question the chart never asked, and once that door is opened, it rarely closes on its own, because the mind prefers certainty to waiting, action to restraint, explanation to silence, and unless the trader learns to recognize that exact moment, that quiet internal shift, he will continue to believe that his losses come from the market, from bad timing, from unlucky breaks, while the real cause remains unnoticed, operating freely beneath the surface, shaping every decision, every risk, every trade, as the chart continues to do what it has always done. The real mistake begins the moment a trader stops waiting for confirmation and starts needing action. That moment is so small, so ordinary, that most men miss it entirely. They think mistakes arrive with noise and drama, but in trading they arrive quietly, disguised as initiative. I learned long ago that the market never punishes a man for waiting, but it is merciless with a man who cannot. Have you ever noticed how uncomfortable silence becomes when you feel you should be doing something? Waiting is the foundation of sound speculation. It is not passive, and it is not lazy. It is deliberate. When you wait properly, you are working. You are watching price behave. You are seeing how it reacts at levels that matter. You are letting the market reveal its intentions instead of guessing them. But the moment a trader feels the need to act, simply to relieve tension, the work stops. Observation gives way to participation, and discipline gives way to desire. The chart always asks for confirmation. It asks for price to hold, or to break, or to fail. It asks for volume to agree. It asks for time, but impulse has no patience for these requests. Impulse wants immediacy. It wants to be early, not right. And that is where the trouble begins. The trader convinces himself that waiting is a risk, when in truth, acting without confirmation is the greater danger. Do you really think the market rewards speed more than accuracy? I have seen men ruin good accounts not because they lacked knowledge, but because they lacked tolerance for waiting. They knew the rules. They could recite them. But in the moment, the urge to be involved overpowered the need to be correct. They entered trades before the setup completed, telling themselves they would add later, or get out quickly if wrong. That is not a plan. That is hope dressed up as control. Confirmation is what separates speculation from guessing. When you wait for it, you allow the market to share the risk with you. When you ignore it, you shoulder the entire burden yourself. The market does not meet you halfway when you act early. It simply continues on its path, indifferent to your position. And if that path does not align with your impulse, the cost is immediate. The need for action often comes from outside the chart. It comes from boredom, from recent losses, from the memory of a missed move. The trader starts thinking about what could happen instead of what is happening. That shift is subtle but decisive. Once you are trading possibilities instead of realities, you are no longer grounded. You are floating, and floating traders are easily swept away. I remember many times sitting in front of the tape, knowing full well that nothing was ready, yet feeling an almost physical urge to take a position. The market had not changed. The setup was incomplete. But my patience had thinned. In those moments, I was not responding to price. I was responding to discomfort. And the market has no sympathy for discomfort. It only recognizes timing. The trader who waits for confirmation accepts uncertainty. He understands that missing a trade is cheaper than forcing one. The trader who needs action cannot accept that. He believes that being flat is being wrong. That belief quietly reshapes behavior. Trades become more frequent. Entries become less precise. Stops become negotiable. All because the trader could not sit still long enough to let the market finish speaking. There is a false pride in early entries. Traders like to say they were first in. But being first means nothing if you are also first to be wrong. The market does not pay for anticipation. It pays for alignment. Confirmation is alignment. It is price agreeing with your analysis. Without it, analysis is just opinion. Wealth in trading is built by protecting capital during unclear periods and pressing advantage during clear ones. That balance depends entirely on waiting. The man who cannot wait treats every moment as an opportunity, and by doing so, he dilutes the value of real opportunities. He spends his capital, emotional and financial, on trades that never deserved it. Can a trader expect consistent results if he gives equal attention to good setups and poor ones? The need for action often feels like confidence, but it is not. True confidence is quiet. It does not rush. It knows that the market will still be there tomorrow. False confidence demands expression. It wants to prove something, usually to the trader himself. That is why impulse trades often come with elaborate explanations. The trader is trying to convince himself that the action was necessary. The market never asks you to hurry. It moves when it moves. The trader who waits for confirmation moves with it, not ahead of it. That synchronization is where edge lies. Break it, and you are on your own. Many traders do not realize how often they trade simply because they are tired of waiting. They mistake fatigue for opportunity. I learned that the hardest skill in trading is not reading charts or understanding trends. It is doing nothing when nothing is required. That skill is invisible. It does not feel productive. But it is what keeps a trader intact long enough to capitalize on real moves. The moment you abandon waiting, you abandon that protection. The real mistake, then, is not the bad entry or the losing trade. It is the internal decision that waiting has become unacceptable. From that point on, the trader is no longer following the market. He is chasing relief, and relief is expensive. The market does not reward those who seek comfort. It rewards those who respect its timing. Once action becomes a need rather than a response, every chart begins to look tradable. Patterns appear where none exist. Levels seem stronger than they are. Confirmation is redefined to fit the urge. And because the market has not yet punished this behavior, the trader believes he has gotten away with it. That belief is dangerous. It encourages repetition. Breaking one small rule quietly opens the door to breaking every important one. That is how discipline is lost in trading, not with a dramatic act of recklessness, but with a minor exception that feels harmless at the time. A trader rarely wakes up and decides to abandon his entire method. He bends it just a little. He tells himself it doesn't matter. And that is precisely why it matters so much. Have you ever noticed how easy it is to justify a small deviation when nothing bad happens right away? Rules exist to protect a trader from himself. They are not there to restrict opportunity, but to filter it. Each rule represents a lesson already paid for, often at a high price. When a trader breaks one, even a minor one, he signals to his own mind that rules are negotiable. And once rules become negotiable, discipline no longer has authority. It becomes a suggestion instead of a command. The first broken rule is almost always subtle. It might be entering a trade a little early, before confirmation is complete, or holding a position a bit longer than planned, just to see if it turns, or increasing size slightly because the setup looks really good. None of these feel dangerous in isolation. In fact, they often feel intelligent. That is why they are so destructive. Do you really think the market distinguishes between a small breach of discipline and a large one? The problem is not the rule itself. The problem is the precedent. Once you allow yourself to break a small rule, you have changed the relationship between yourself and your process. The next time a rule gets in the way of an impulse, it is easier to override it. The resistance is weaker, the hesitation shorter. Over time, the rules that once governed your trading become flexible guidelines, and then optional suggestions, and eventually background noise. I learned early that consistency in trading does not come from having good rules, but from obeying them without exception. The market is not impressed by intentions. It responds only to behavior. A trader who occasionally breaks his rules is not disciplined. He is lucky when things go his way and confused when they do not. And confusion is expensive. Small rule breaking often begins during periods of comfort. After a string of winning trades, a trader feels in sync with the market. He feels sharp. That confidence encourages experimentation. He takes a trade that doesn't quite fit. It works. The account grows. And the lesson he absorbs is the wrong one. He learns that discipline is optional. Have you ever noticed how success can weaken rules faster than failure? Losses caused by small rule breaking rarely appear immediately. That delay is dangerous. It reinforces the behavior. The trader thinks, nothing bad happened last time. But markets do not operate on immediate feedback. They operate on probability over time. You can break rules repeatedly and still survive for a while, but eventually, probability asserts itself. And when it does, the damage reflects not just one broken rule, but a pattern of them. There is also a psychological shift that occurs once rules are broken. The trader becomes more focused on outcomes than on process. He starts judging decisions by results instead of correctness. A bad trade that makes money feels justified. A good trade that loses feels wrong. That inversion destroys discipline at its core. Can a trader remain consistent if he rewards himself for bad behavior? Each rule in a trading plan supports the others. They work as a system. When you remove one piece, the structure weakens. Break an entry rule, and risk management becomes harder. Bend a stop rule, and position sizing loses meaning. Ignore a time-based rule, and emotional fatigue sets in. What seems like a small adjustment often has consequences that ripple through the entire process. The market has a way of testing traders gradually. It allows small mistakes to pass without punishment, encouraging repetition. Then, when confidence is high and caution is low, it delivers a lesson large enough to erase weeks or months of progress. By then, the trader is no longer just breaking one rule. He is operating without any real framework at all. Wealth in trading is built through compounding correct behavior. That compounding requires stability. Stability requires rules that are followed regardless of mood, recent results, or outside pressure. When a trader breaks small rules, he introduces instability. Returns become inconsistent, risk becomes unpredictable, and the account begins to reflect not the edge of the strategy, but the variability of the trader's emotions. Many traders believe they can control which rules they break. They think they will bend only the less important ones. That belief is an illusion. Once the mind accepts flexibility, it applies it everywhere. Today it's an early entry. Tomorrow it's a wider stop. Next week it's revenge trading after a loss. Discipline does not erode evenly. It collapses inward, one justification at a time. I found that the most dangerous words in trading are, just this once. Those words signal that a rule is being sacrificed for comfort. And comfort is never free in the market. Every exception carries a hidden cost, even if it does not show up immediately on the ledger. Over time, those costs accumulate, quietly draining confidence, clarity, and consistency. The trader who respects small rules stays aligned with his process even during dull periods. He understands that rules are most important when they feel unnecessary. The trader who breaks them does so because he feels they are slowing him down. But rules are meant to slow you down. They are meant to create friction between impulse and action. Remove that friction, and impulse moves unchecked. Markets reward those who survive long enough to exploit real opportunities. Survival depends on discipline. Discipline depends on respecting rules when it feels inconvenient.